Let's take a look at futures this morning. The markets are now open after being closed for the Christmas holiday. Markets had closed early on Wednesday. As you can see, the Dow is down 55 points in the pre-market and the S&P as well. Stocks did extend the year-end rally on Wednesday. The S&P 500 rising to a fresh all-time high, driven by optimism around economic growth and stronger corporate earnings expectations. Investors are watching for the Santa Claus rally, a historical year-end boost spanning the final trading days of the month of December into the first sessions of the new year. Markets notching strong gains this year. Obviously, you had that big AI-powered rally for the year. The Nasdaq, get this, up 22%. The S&P 500 up 18%. The Dow for the year so far gaining 14%. I want to bring in Constellation Research CEO Wang. And Ray, good morning to you. I hope you had a good Christmas day. We've laid out 5 major trends that could shape markets in 2026. You've got AI productivity, energy, real assets. Which of these do you think is going to be the most powerful driver for investors? I'm still trying to get over what gold has done in 2025.
You know, this battle for real assets is coming in play, right? Anything for energy or water or minerals, rare earths, they're picking up steam. Gold, silver, you've seen the trade. And I think it's only going to continue. We have so much money locked up in the market in all different sectors, but it's all going to come down to what do you physically have? And, you know, I'm more an equities guy, but I can see the real assets piece ticking up. And then the other area is really around AI-powered growth. You're seeing companies like Walmart and Pfizer, they're taking massive gains in terms of exponential efficiency, in terms of being able to be productive with their people. And we're also seeing a number of startups. And the one I'm really excited about is the IPO boom we hope happens coming in 2026. If all the conditions come into place and we see interest rates drop, we're going to be able to see a chance for a really huge IPO boom with so many companies in the pipeline for 2026.
Yeah, no, I agree with you there. And also, you know, we're going to get a new Fed chair. Certainly the markets are going to be cheering a Fed chair that's likely going to be more amenable to further rate cuts. And I know that the street is expecting that at least beginning in April, if not sooner. Let's talk a stock. It is Nvidia. Again, this is the stock we always talk about. Technology licensing deal has been struck now with AI chip startup Grok, getting access to its tech, and it's integrating Grok's chip design into future products. So this brings Grok's CEO and senior leaders to Nvidia while Grok operates as an independent company. And I hope I'm saying that company name correctly. You may have to tell me, Ray. But Nvidia says the move expands its AI factory platform, and this will target real-time and inference workloads as competition intensifies. Break this down for us. Why the importance of this very large-scale deal from Nvidia and this company?
This is huge, and part of the reason that Grok is on fire is because of a thing called TPUs. These tensor processing units are similar to the GPUs in terms of being a chip that's being used in AI, but TPUs are really important in an area called inference. So once you've trained the chips, then the question is, what do you do with it? And that's where inference comes into play. Well, Nvidia didn't have any offerings in TPUs, and Google is actually the leader in TPUs, and we're seeing the AI market move to TPUs. Grok is a whole number. The founders of Grok all came from the Google team that built those TPUs, and this is a critical move if Nvidia wants to continue to stay in the lead. That's probably why the market will be cheering this move for quite some time, and of course, the Grok team in terms of their ability to actually stay a couple steps ahead of where the market's going to be.
Grok, not to be confused with Grok and AI and Elon Musk. There you go, Ray. John Lonsky, I want to bring you into this and talk about the economy, because in 2025, what an incredible year we've had. In particular, it was the consumer spending asset, and then you had that unbelievable GDP number, much better than expected, that read we got on GDP for Q3 on Wednesday. So as we move into 2026, John, it looks like the market is powering the consumer. Yeah, let me bring in John Lonsky. John, go ahead.
Yeah, I'll go ahead. I think what I want to point out is that there is an unsustainable imbalance that we have as far as consumer spending is concerned. And that is a simple fact that while the economy does well, while economic growth exceeds expectations, payrolls, or the number of jobs, are barely growing. And in fact, if you look closely at the data on third quarter real GDP, what you find is that the 2.6%, nearly 3% year-over-year increase by real consumer spending was was much faster than the 1.5% yearly increase by real after-tax income. Slower growth by real incomes is a consequence of this dramatic slowing of jobs growth. At some point, unless we get a recovery by jobs growth, we are going to see a notable slowing by consumer spending that would lead to slower than expected growth in 2026.
John, I'm going to push back on you, though, because we've had these predictions before that the consumer was going to falter. We had this especially after April and Liberation Day from the tariff threats, deregulation. It didn't come to pass. And the numbers that we're seeing now from holiday spending, even those numbers haven't come to pass of the predictions. So you can predict it, but at the same time, it is the top 10% of wage earners in this country that are powering ahead the economy, John, excuse me. And we got that in that GDP read that we got on Wednesday. Respond to that.
I don't know. I think everybody is spending money. My goodness, you have had in the auto industry, they have had to resort to 100-month-long auto loans in order to make new automobiles, new motor vehicles affordable for middle-class Americans. And when you think about when they say that 10% of the highest income decile, that top 10% is responsible for this consumer spending growth, I think people are getting a little bit carried away there. I mean, just in real terms, how could 10% of Americans be responsible for 50% of real consumer spending? It's just absolutely impossible. I think people are going out in a stretch. They're taking out debt. At some point, this lack of jobs creation catches up with the U.S. economy. Now, I'll go so far, though, as make the prediction that later, not that late into 2026, we'll see a recovery by jobs growth. And believe it or not, with jobs growth picking up, with all of the stimulus coming in from the big, beautiful bill, and who knows, maybe we'll get some of this direct foreign investment kicking in. We'll be talking about rate hikes in the second half of this year.
Well, we've got a lot more to talk about. Ray, it was great to see you. Thank you for joining us. Hope you had a great Christmas. We're back to the races this morning with the markets. Ray Wang, thank you, sir. We're going to be right back, everybody.